It's before sunrise. The streets are empty. Screens glow quietly in dark rooms. This is the hour when markets appear calm, when nothing seems to be happening. And yet, this is almost always when the most important shifts begin. Not during press conferences, not during televised debates, but inside dense regulatory documents that most people will never read. Over the last several hours, I've been studying one of those documents. It didn't trend on social media. It didn't lead the financial news cycle. It didn't spark outrage or excitement. But buried inside it is a rule change that fundamentally alters how the global banking system treats gold and silver for the first time in more than half a century. And unlike most regulatory changes, this one is already in force. Not next year, not after a review, now. This isn't a theory, it isn't speculation, it isn't a trading idea. It's a rewrite of the rules themselves. And when the rules change, behavior follows, whether people notice or not. To understand why this matters, we need to zoom out. Far above governments, markets, and even central banks sits an institution most people have never heard of. It doesn't advertise, it doesn't campaign, it doesn't answer to voters. Yet every major central bank on earth ultimately answers to it, the Bank for International Settlements, the BIS. Think of it as the referee of the global financial system. When it rewrites the rulebook, the entire system adjusts. After the 2008 financial crisis nearly collapsed global finance, regulators reached a blunt conclusion. Banks were fragile, excessively leveraged, and dangerously dependent on assets that vanished when stress appeared. So the BIS began a slow reconstruction of banking rules from the ground up. This wasn't dramatic. It didn't happen overnight. It unfolded quietly, in phases, over more than a decade. And now, with the final phase implemented, the framework is complete. Here is the change that alters everything. Under the new standards, physical gold and physical silver, real metal that is fully owned, properly allocated, independently audited, and securely stored, are no longer treated as speculative commodities. They have been elevated to the highest category of balance sheet assets, Tier 1 capital, the same class as cash and government bonds. That is not a metaphor. It is a regulatory classification. In plain language, this means a bank that holds real physical metal can use it to strengthen its core capital position. Its ratios improve, regulatory pressure eases, the institution looks safer, more resilient, and more compliant, exactly what regulators are demanding. But there is a strict line. Paper claims do not count. Unallocated metal does not count. Futures, swaps, and derivatives do not count. Only metal that physically exists is clearly owned and cannot be disputed. That distinction is where the pressure begins. For decades, the precious metals market has been dominated by paper exposure, contracts instead of custody, promises instead of possession, synthetic supply layered on top of a limited physical base. This structure worked because gold and silver were treated as secondary assets, higher risk, capital inefficient. Under the new rules, that classification is gone. And once it's gone, the incentives flip. Banks now face a choice they can't ignore. Either acquire real metal or lose a capital advantage they can no longer afford to give up. This shift has nothing to do with sentiment, fear, or geopolitics. It is not about inflation narratives or industrial demand forecasts. It is about compliance, and compliance drives behavior mechanically. When regulators redefine what strengthens a balance sheet, banks respond not emotionally but mathematically. And mathematics moves markets quietly at first, then suddenly. This change also dismantles something else that has gone largely unnoticed, the economics of excessive paper exposure. For years, paper metal positions were cheap to maintain. Under the new framework, they are not. Positions that once made sense suddenly become expensive. Trades that were easy to justify become difficult to defend. That is how long-standing distortions unwind. not through panic, but through balance sheet arithmetic. None of this guarantees higher prices, no regulation ever does, but it fundamentally changes the plumbing of the system. And when the plumbing changes, flows change. That is why this moment matters, not because it's dramatic, not because it's loud, but because it's structural. These are the moments people only recognize years later when they look back and say, that was the turning point, and it started quietly, in a document almost no one read. Now look closely at what the rule is actually saying. From this point forward, if a bank has sold gold or silver it does not physically own, regulators demand compensation in the form of real capital, not symbolic buffers, not accounting maneuvers, actual top-tier capital, the kind that belongs to shareholders. And if a bank doesn't comply, enforcement is immediate. Dividends can be restricted, executive bonuses can be reduced, supervisory oversight fast tightens. That alone changes everything. Short positions are no longer casual opinions. They now carry a measurable cost that directly reduces returns. From a bank's perspective, the logic is simple. If maintaining a short position requires locking up hundreds of millions of dollars in high-quality capital that could otherwise earn steady returns elsewhere, that position must justify itself. And most precious metal shorts never could.
Thin margins, infrequent gains, long stretches of inactivity. Once the true cost of capital is applied, the math stops working. The rational response isn't clever. It's obvious. Close the position, free the capital, redeploy it. That isn't ideology. That's balance sheet survival. And this isn't hypothetical. Even before full implementation, institutional exposure has already begun to shrink. Open interest has been quietly declining, not because interest vanished, but because institutions are stepping away. No announcements, no speeches, just exits. The risk comes when too many players try to exit at the same time. Prices don't rise politely in those moments. They gap. Liquidity disappears. That is not speculation. That is market mechanics. And this pressure is not coming from retail traders or social media narratives. It is coming from compliance schedules and regulatory deadlines. Banks don't choose the timing. The calendar chooses for them. There is a transition window. Regulators aren't demanding perfection overnight, but they are demanding progress. Miss early milestones and scrutiny intensifies. Miss later deadlines and consequences become unavoidable. That creates a countdown. Institutions now have a limited period to either convert paper exposure into fully backed physical holdings or eliminate exposure entirely. Both paths require action. Neither allows delay. And this is where physical reality intervenes. Gold and silver are not software. You cannot scale them on demand. Global supply is largely committed through mining output, industrial use, long-term contracts, and reserves. What actually trades freely is a narrow slice of the market. When large institutions need size, real size, they do not acquire it quietly. They compete, and competition in a constrained physical market resolves through price. This next phase is not about opinions. It is about throughput. How much metal can realistically be sourced? How quickly and at what cost? When regulatory deadlines collide with physical limits, something must give. That is the core tension. Not fear, not hype. A system where incentives have changed in a market that has very little slack. This pressure does not stop with banks. It flows downstream to anyone holding precious metals through the banking system, especially through unallocated accounts. Under the new rules, those structures consume capital without providing regulatory benefit. Banks are being pushed to restructure them. That means account holders will be contacted and given choices. Convert to fully allocated storage with explicit custody. Exit the position and receive cash. Or convert the claim into a bank-issued instrument, replacing metal exposure with credit exposure. That distinction matters. One is ownership. The other is a promise. This is not about urgency, it is about structure. The rules reshape incentives first for banks, then for everyone connected to them. Paper convenience is being replaced by physical accountability.
Anything that does not fit becomes more expensive to maintain. Starting January 13, 2026, the Basel III Endgame rules are fully in effect. Gold and silver are now treated as Tier 1 capital. Banks are rewarded for holding physical metal and penalized for relying on paper exposure. For the first time since 1971, precious metals are being quietly remonetized, not through speeches, not through headlines, but through incentives embedded directly into the regulatory framework. This is the largest structural shift in the precious metals market in half a century. Most people will not notice it at first. Coverage will remain limited. But banks understand, and markets are already adjusting. What happens next will unfold quietly at first, then all at once.